Opendoor just went vertical. A 120% intraday surge, viral hype, and volume off the charts. Some folks made a killing. Others might be holding the bag. So, what's really going on with this stock? On July 21st, Open spiked to $497, its highest level in over a year, before settling up 43% on the day. But just one day later, boom, the brakes slammed. Shares dropped 10%, closing at 288, with over 1 billion shares traded. That's 7x as the usual volume. The spark. Hedge fund manager Eric Jackson, best known for his early Carvana call, went public with a big open stake. He called it a 100 bagger. Like Carvana, Opendoor wants to digitize a messy offline business, but losses are piling up fast. Here's something you might not know. In Q1, only 10% of homes sold were actually flipped by Opendoor. The rest? Partner listings through their marketplace. That's a huge shift in the model, and a sign they're trying to reduce risk. If you've been watching this stock, or holding it since it dipped below $1, this rally might feel like sweet redemption. But let's get real about the risks. In Q1, they posted $85 million in net losses on $1.2 billion in revenue. That's just an 8.6% gross margin, and nearly $370 million lost over 12 months. For Q2, they're guiding for a small adjusted profit. But here's the catch. That depends on scaling partner listings, not traditional home flips. And as of late July, they're still trying to avoid a Nasdaq delisting. A vote on July 28th could approve a 1-for-50 reverse split just to stay above $1. Technically, Open blasted through 2.75 resistance and cooled back near support around $2.60, $2.70. RSI cooled from over 80 to the low 50s. That's a red flag for momentum. Mortgage rates? Still stuck near 6.8%. Inventories rising. Prices? Flat at best. That's a tough backdrop for any iBuyer trying to move homes fast. Now, Wall Street? Not convinced. Most analysts say hold or sell, with average targets around 155. That's half the current price. But retail's not listening. Open is trending hard on Reddit and StockTwits, and sentiment's rated extremely bullish. With 22% of the float shorted, another squeeze could fire off fast. Meanwhile, insiders sitting out. No major buying from execs. If leadership really believed in the massive upside bulls are hyping, you'd expect them to be buying too. Here's what to consider. Already in? Lock in gains or use tight stops around 260. Thinking of buying? Wait for consolidation or legit signs of profitability. Long-term holder? High risk. Unless margins improve or housing rebounds, this could turn into a value trap. To recap, Opendoor's rally? Retail-driven, not fundamental. Losses are real, housing headwinds are strong. Analysts are bearish. Insiders sitting on the sidelines. This one's either a rocket or a wrecking ball. Just don't be the last one holding the bag. Smash that like button, drop your thoughts below, and subscribe for more no-hype breakdowns.